Hello, everyone, and welcome to the webinar today. We are so thrilled to have you with us. Today, we have a really fantastic topic about how to find and finance and land your next multifamily deal, which is super exciting. I know this market is crazy. It seems like every day we're hearing something different. And so we've brought on three experts to go over a lot of what you should know before you make your next move or to determine what your next move would be and when. So before we start that, though, I'd like to first give a thank you to our sponsor today, DirecTV, and a quick little commercial here about what they have to offer. Let me share my screen here so you can see what I'm talking about directly. So let me know if you can see the screen here. Give me just a second. Hold on. I think need to share that just slightly differently here. Okay, here it is, full screen, DirecTV. Property owners and managers, are you ready to elevate your residents' entertainment experience? With DirecTV's bulk streaming TV service, you can transform your multifamily property into the ultimate entertainment solution. So imagine offering your residents instant access to world-class movies, TV shows, news, and premium sports networks, all without the need for a satellite dish or new infrastructure. DirecTV bulk streaming TV is delivered over your property's existing internet connection. And with DirecTV's bulk streaming TV, you get national bulk pricing that is up to 70% off MSRP retail pricing. Plus, the installation's a breeze with fast and easy self-setup, so allows your residents to start streaming immediately. By offering DirecTV's premium content, you'll attract and retain residents and grow your revenue without any capital or infrastructure changes. So don't miss out on this opportunity to enhance your property's appeal. You can visit directv-mdu.com or scan this QR code you see up on your screen to get a request proposal for your multifamily property. I'm also dropping a link in the chat for you all as well, so you can check that out. This is, like it says, something that really all of you can participate in, small or large multifamily properties. So go ahead and click on that link in the chat, or you can scan the QR code that we have up here on the screen. And we also have a quick poll question from our sponsor today as well. Just a little bit of fun trivia here. So in 2024, what percentage of American TV consumers spend more than 3 hours a day watching TV? I don't know about you, but I definitely have my shows that I see. So 3 hours, I don't know, maybe between all of my shows, possibly. Yeah, okay. So I'd love to know which one of you think it's 20, 40, 60, or 80%. And then I'll share the results here in just a second. All right. So looks like we have a tie between 40 and 60%, and the right answer is 60%. That's a lot of time watching TV. So all that to say, it's probably important to your residents to make sure they have access to their favorite streaming services. So I'll go ahead and stop sharing those results and my screen for just a second. And now we can get started into our presentation today. So as I mentioned, we have three wonderful speakers with us today. We have on, I don't know if it's on your left, it is for me, Stacy Conkey, who is co-founder of the Multifamily Investing Academy. She has led the #1 multifamily education company that specializes in helping students acquire small apartment buildings. And she's also had a decade of experience investing and has taught thousands of people across the globe. Also, we have with us Taylor Avakian, the multifamily broker and founder of the group CRE. He's one of LA Times commercial real estate visionaries of 2023. He's one of the most active commercial and real estate brokers in Southern California and has sold over $300 million worth of commercial real estate. and evaluated over 1,000 properties. We also have Anne Peterson, who is the Senior Director of Old Capital. She's affectionately known as the First Lady of Lending, and she has 33 years in real estate transactions. She's not just a debt provider, she's a strategic consultant and helps her clients get educated. She has also multifamily assets across several states, well versed in 1031s, 401k, solo 401k accounts, self-directed. And she's also had a lot of partnerships, bringing in over $8 million. Lots and lots here of experience. So really excited to dive in today with all of you and, learn what we can from our experts. So I'd like to start first by asking our experts to briefly tell us how they got started in multifamily and what their business looks like today. I'll start with you, Stacy. I'd love to hear a little bit of background.
Sure. First of all, thank you for having me, and hello, everybody. I'm excited to be here with you today. For me, it started 22 years ago, so a long time ago. And I think I started the way that most people start, was doing some fix and flips and some small multifamily, some duplexes, and then moved into small apartment buildings, then larger apartment buildings. So it was just a progression. And, every step along the way, it was learning and sometimes painful, sometimes not. But yeah, it was just 22 years of slowly but surely moving up and figuring it out and then passing it along to people like you guys who are here.
Wonderful. And what are you doing today? What's your day-to-day look like?
Oh my God. Well, I run 5 businesses, so my days are very busy. I wasn't even on the map for that poll. TV is a very big part of our lives these days. But 4 out of the 5 businesses that we have are real estate related, and so any given day, I'm either raising capital for a deal, evaluating a deal, helping one of my students with the deal, or chasing one of my 4 kids around trying to get them to do their homework. It's basically average day. It's
Oh my
chaotic.
gosh. Sounds like it. Taylor, what about you? How did you get started in multifamily real estate or
Yeah, Alex.
commercial for that
Yeah,
matter?
thank you very much for having me. Yeah, so it started really when I was in high school with some family friends who were in the development space. They developed affordable apartments, and truthfully, it was one of envy at a certain point. They had the best snacks at their house. They had a second house in Tahoe, and I said, you know what? Whatever he's doing, I want to do that. And so it was one of those situations. And then I went to University of Alabama. I studied finance and real estate as a specialization. And at that point, it became very clear to me that real estate could be a business that I wanted to pursue. So in 2018, I joined a firm called Matthews Real Estate, which at the time had 75 agents. They said, hey, here's a phone. Here's some numbers. You're going to call Koreatown, Los Angeles. And I spent the next 5 years making 500 to 600 phone calls, building a ton of relationships with owners, and through that process, finding some success somehow and selling multifamily, and have been doing it ever since. So now, my day to day right now is helping clients with investment plans. We have a big portfolio out to market. It's a lot of finding deals, helping owners figure out the new regulations and laws in Los Angeles because those are constantly changing, educating. I have a podcast now as well that I get to interview some very successful people, and learn from them, really. So it's a lot of day-to-day conversations. I'm on the phone probably 75% of the day, but it's fun.
That's great. That's great. Sounds busy as well. And Julianne, what about you?
Oh, well, my journey started when I was 14. I'm a lender, so at 14 I actually worked for a bank. I was a bank teller. So I've
Really?
had my hands in this area of money. Bought my first house in San Pedro at 22, $250,000, and the riots came. And my asset went from 250 to 179,000 in overnight.
Oh,
So I gave my brand new home that I had owned to a friend for $4,000. So I've been on the trajectory. Either it's I'm either winning or I'm losing, which is how real estate is. And so I've been in doing transactions, like I say, about 33 years, and really wanted to be owner operator. I own my own assets, and at some point I couldn't buy any more by myself. So wanted to get with a team sold all my assets, went in as a limited partner, worked as a loan officer, and I said, I've been doing this all by myself. I need to be in the daily grind of it. So I do both limited and general partnership as a daily owner operator. And I absolutely love it. But, the partnerships are a big thing that you need to make sure that you have, start out on the right foot together. So my days look like uh, looking at deals for my clients, but also for myself,
Mm.
closing loans, and then, owning and operating our current assets.
So Julianne, as I mean, you've seen so many market fluctuations, you look at so many deals. So what are you seeing right now in multifamily that is particularly important for our investors to pay attention to right now?
Well, I could use this whole hour to talk about that, and I don't want to do that, but I would tell you that, over the last year, we have seen a lot of maturities, loan maturities coming due, whether it was on bridge that people took out 3 years ago with
Mm.
that were adjustable. So we've seen the interest rates go up. Just over the last 2 days, 3 days, we've seen them drop and then come back up. So there is a lot of stuff going on. The maturities, the interest rates. We've got inventory that are having a difficult time being absorbed in some of these, the the Sunbelt states. Occupancy has dropped significantly because of that absorption. So there's a lot going on a daily basis of in the market, whether it's as a buyer or as a lender. So a lot to talk about.
Absolutely. And I know, Taylor, you're focused on the Southern California area. So, from your perspective, how are those factors affecting your clients?
Yeah, great question. I think what's unique about Southern California and California as a whole is we're very regulatory heavy, regulation heavy. And so I think a lot of owners have been dealing with the constant changes when it comes to being a landlord from regulations. Obviously, with the influence of the market and interest rates, like Julianne said, it's been very difficult to make deals happen in pencil. Across the board, at least in the city of Los Angeles, we've seen prices shift anywhere between 15 and 30% in terms of a decrease in value. So it's felt like more of a buyer's market in today's current environment. And so what we're working to figure out is where are the opportunities? Where can you go invest? Where can you get a deal? Is it possible in today's market? And or the short answer is yes. How do you go and find these deals to make them pencil and to go get your investment? So similar to Julianne, it's been a whirlwind, and we're hoping normalcy. But in real estate, that doesn't last very long. So we'll see.
Yeah, yeah, definitely. And Stacy, you remote invest. I mean, I initially met Stacy because she was writing for us about remote investing and making that leap. So you see a lot of different markets as well. Would you say the same holds true from what you're seeing, or are you seeing anything different?
So, um, part of I feel like the experience that I get or the exposure that I get to what's going on is so much broader than just what I do because I have 5 years of students doing it and getting and started. So what I see more of, just because this is what is surrounding me, is smaller apartment buildings. 10 to 40 units is usually what my students are working on, and in that area, there was a period of time where there was not very much deal flow. Like everything seemed very stuck. And in probably the last 6 months, have my students are starting to close and close and close.
Mm.
And so I feel like things have loosened up. The biggest wisdom that I share with them when you're going through, because I've been in this for 22 years. So, I've seen it all. And I just tell them, like, look, when interest rates are low, it seems like, oh my gosh, that's the perfect time. But the reality is, when interest rates are low, it's way more competitive also. And then interest rates go up to where they were when I started 22 years ago. So this is kind of normal to me. And so it's harder to make the numbers pencil, but there's fewer investors because people back off during times like this. So my biggest advice to them is, look, you're going to have to make a lot of offers. You're going to have to evaluate a lot of deals. Like if you want something different in life, you have to be willing to do different things to get it. Underwrite conservatively, very conservatively, and get them out there. When you find someone who they want to sell and you want to buy it and it matches up, then go for it. But I've seen a lot more activity, and it's probably because none of our students invest in California. Many of them live there, but they invest elsewhere just because they don't have the capital to make it work there. But in the smaller deals, like the 10 to 40 range, it's definitely loosened up. But it takes conservative underwriting and analyzing a lot of deals.
Hmm.
But they're happening. We're having a couple deals close every month right now.
Oh, good,
Nice
good.
deals.
Yeah, so we're seeing some movement. And speaking of that, I think what I'm going to do is pass it off to you, Taylor, to share your slides because let's talk about some ways we can find those deals, maybe off-market deals. I'm sure Stacy, you have some tips on how to do that as well. So I'll maybe come back to you for that too. And then also, what actually makes a good deal, especially in a place like Southern California. So if we were to look at Southern California, which is a difficult, typically place to invest, is there, a way to actually still find opportunity in Southern California? So Taylor, I'll pass it off to you.
Perfect. Can you guys see the screen? Are we
Looks
good?
great. Yep, all
All
good.
right, perfect. So, yeah, appreciate it. So, a lot of my business when I talk to buyers and investors, it's, hey, give me an off-market deal because as many of us know, if you haven't invested, typically the best deals are found off-market. And that's because when you hire a broker to go and market your asset, you want to show it to as many people as possible. When a deal is off-market, it inherently has less competition, which means there's opportunities to get a better price. And so throughout the process of working as an owner, you see deals, I mean, excuse me, as a broker, you see deals that trade off market. And there's a few ways as an investor yourself can do this process. And so I'll walk through a few of those. And again, if there's a lot of information on here, if you guys want to go download this, there's a link down there. You can copy that after the presentation, and this will be all available. We put it together for you. But the first way really is doing it yourself, DIY. And what this looks like is you're driving around, you see a property that you're interested in, and you write it down, take a note, and you try to find the owner and call them and see if that they would sell to you directly. This is a less common way to do that, I would say, but definitely effective if you're able to go and find the information for an owner. And for better or for worse, it is a lot easier to find the phone numbers and information for people nowadays. So there's plenty of databases out there, public, free resources that you can use. One that a lot of people use is called free people search. So you can go and look up, pretty much a lot of information, and maybe you want to go look up if your number's on there at any point. But that's a resource that I know a lot of people use. The other one is kind of auctions. You can go and try to find these auctions. For real estate deals. And this isn't typically necessarily off market, but you'd be surprised at how many few people show up at the court steps to buy deals that are very, very well priced and attractive. I've been shocked. I've shown up to a few with some clients and looking at our own deals, and there's two people there. So it's a good place to do that. And then direct mail and outreach. I think that's a given. You have 1,000 letters, you send them out, and hopefully you can get a response. You cut out the broker, right? People don't like to pay commissions, and sometimes you can find a good deal when someone wants to go that route. The other way, and I'm gonna skip the networking, but I think that's a great way to do that too. And again, I think you guys can speak a little bit further to the network, Stacy, because that's kind of your whole shtick. But from a broker's perspective, 95% of the deals, if you're an active investor, are going to be coming from a broker, and that includes off-market deals. And so I would say the biggest lever to pull is to start becoming friendly and get on the radar of those brokers who are actively doing the deals, because they're the ones who are calling the owners day in and day out. They're building their relationships. Sometimes there's owners who don't want to deal with the hassle of going on the market and are willing to transact off market. And you get those through the relationships that you have with those trusted brokers who've built those relationships over the years. So if I had one piece of advice, I would say 100% try to start reaching out to those active brokers, building relationships, telling them exactly, here's my buy box, here's how much money I have, here's the deal that I'm looking for. Understanding what kind of asset you want to purchase is very helpful for someone like myself, because when someone says, hey, I want to buy a good deal means a million things to a million different people, right? And so I think clearly defining your business plan, what you're looking for in a deal, whether that's off market or on market, is very, very important to actually getting something over the finish line. Setting that foundation up first is fundamental in being a really good owner and operator. And those are some of the things that we've kind of seen and what I've seen be very successful in terms of finding those deals.
Great. Thank you for that. Stacy, so comment there on the networking aspect. How are you finding some of these off-market deals, or what kind of connections are you making to get access to that?
So on the network side, on the network side, it really is more about like who you know. Because we have an academy of people who are active, our students end up doing deals with each other from a network standpoint. But that is not actually how I teach people to find deals or find properties. So something that Taylor said, I'm like, that's exactly what I've been teaching from day one. There's 100 different ways you can go find real estate or properties, but a lot of them are so time consuming. They're not realistic if you have a job and a family and everything else. And I know that most people, when they're getting started in real estate, and I don't know the audience, I don't know how experienced the audience is. So I realize I feel like I'm speaking more to the beginner. I don't know if everyone here is more on the beginner side or more experienced. So tell me if you need me to like pivot a little bit, but I'll speak more to the newer investor. When you're getting started, it feels like there's so many different ways you can do it, and you want to do everything. And you could literally end up eating up years of time just looking for a deal. And there is one single way that is the absolute fastest, most effective way to get real estate, any kind of real estate, especially multifamily. And that is leveraging the relationships that you build with brokers, like exactly what Taylor said. And I don't teach my students like that they should do off market or not off market. It's just a function of the relationship that's built. It's usually going to end up being something that is off market if they build that relationship. But that is the absolute number one way. And, to Taylor's point, people sometimes they don't want to pay the commission, or they're trying to save money. They're going to do it yourself. But man, like, what is your time worth? And how much faster could you scale if you can let go of trying to like to hold on to the penny and recognize that there is, $100 bill waiting for you if you're willing to leverage your time and leverage the relationships and let the other people on your team make the money that they're going to make, because that helps both of you and it just helps you grow. So sometimes it's a little bit of a mindset shift, but 100% all day long, I teach just build relationships with brokers. They are the ones that are on the front lines. They're the ones that have been busting their butt to build all those relationships with all the sellers. Like, it's going to take you forever. You're going to make 500 or 600 phone calls like Taylor did? No way, not a chance. And nor should you. That's not your job as the investor. Your job is to figure out the fastest, best way to get deal flow. And that would be leveraging brokers in the markets that you're interested in investing in.
Love that. And you mentioned just now the markets that you're interested in investing in. So when it comes to your students, Stacy, how do you tell them, or how do they decide what's the right market that they should be investing in?
So it's going to depend a lot on what strategy, or it always starts with goal. Like, what are you trying to accomplish? And what you're trying to accomplish is going to impact what strategy you choose. And then what strategy you're choosing is going to impact what market you select. So for example, if someone is going for like cash flow is their number one goal, it's always like cash flow or equity. Those are the ways I kind of break it out, and, or both. So if you're looking for, cash flow, you're going to be in a market that is, you're not going to see a ton of appreciation. It's not going to be low cap rates. You don't have a ton of value add opportunity as much. So if your goal is cash flow, then your strategy is looking for stabilized property. So you got to be in an area that's a little bit less competitive in order to make that happen. If you're looking for value add, where you're going to go in and change the operations, fix it up, drive the net operating income up, and you want that to really matter, you're going to be in a market that is more competitive and is more expensive. But and the lower cap rates that go with those more expensive markets is what makes those operational changes so valuable. So it's
Mhm.
not a matter of like which market, it's aligning what your goal is with what strategy and then picking a market that makes sense for that. Like, Cape Coral, Florida is not a place you're going to go for cash flow, but you can all day long do a value add deal, there, assuming the numbers work. Hamlet, Indiana is not somewhere you're going to go do a value add deal. It's just not because it's like a tiny little place, but it's great for cash flow because the prices are lower. So,
Mhm.
we picked up a 13-unit apartment building with 20 storage units for $705,000 last year, and it cash flows like a monster. I don't expect we're going to make a huge amount of equity on it because it's just this little podunk market. So it's choosing the market that makes sense based on what you're trying to accomplish.
I love that. I love those examples as well. And I'm going to actually put this back to Taylor because I'd like to go over some of red flags that we should be looking out for when evaluating properties. So once you have the right strategy and you are in the right market that you like, what are red flags that might pop up? So Taylor, I'll let you take this part away.
Yep, thank you. And very well said, Stacy. I could not agree more. Even though it sounded very self-serving to me, it's like it's if I was buying a deal in a different market, I would run this exact playbook. So no, it's very true. So some red flags to look out for when you're evaluating property. Just when you look at some descriptions of properties that are being marketed, right? Value add, we have buzzwords as brokers that we use. And what those are meant to do is to create interest. Our job is really we're professional marketers who sell real estate. And so we use these words and these claims that can be used on our marketing materials, but if you don't understand the fundamentals of the actual real estate itself, it really doesn't mean anything. I could have a value add property in rent controlled Los Angeles with tenants who are paying $2,000 below market. Good luck going and trying to execute a value add business plan on that. It's almost impossible, right? But that's a value add deal. So I'd say one red flag to look out for are potentially these buzzwords that brokers are notoriously known for using. Dig into that. That should be something where your head spikes. Okay, let me dig a little bit further. What do they mean by that? Why is that the case? Is it possible to do my business plan if you are looking for value add? When you're actually looking at the property itself, if you go and drive by the neighborhood, look at how the other properties on the street are. Look at if there's trash, different places. If you get someone to actually get to the step of going and inspecting the property, you got to look for the big ticket items. You got to look for, is my foundation good? Are my pipes good? Are the electrical panels updated? Because especially today, and I'm sure many of you guys are aware of this if you own properties, insurance is so tough and it's gone up like crazy. And if I just had a client who bought a property in Inglewood, uh, they bought the property, got an insurance quote, great insurance quote they're happy with. They had to do the insurance inspection. The inspector came out and said, "Hey, you need to replace these panels in 26 days or we're canceling your insurance." And in the meantime, they had to pay 3x to get a short-term insurance policy to be able to cover that because they couldn't get those panels replaced in that 28-day period. So situations like that, understanding where things could go wrong, and also having conversations with people, I think from the networking perspective and people like Stacy and also Julianne who have experience of this, look for what those items could be. Have a checklist when you're going into a property of here are the big ticket items that if these are not solved or I'm not uncovering these, it could really be a big hit to my cash outlays of making this deal make sense. Obviously, financial projections. If you see an OM, do your due diligence on that offering memorandum, on that setup sheet. If someone's giving you a 25% expense ratio, and I'm speaking specifically for Southern California, but if someone's giving you a 25% expense ratio, there's very little truth and likelihood that that's realistic, right? It says on the marketing packages of these OMs, do your own due diligence. That is the expenses are the number one thing. I'd make sure to request that information from the broker, the actual profit and loss statement, the actual expenses. Are there anomalies in the utility bills? Is it something that you can fix? And sometimes those are actually opportunities for you too. If you think a bill is wildly high and you can implement something like RUBS, which is ratioed utility billing service, which basically bills back the utilities to the tenants, those are opportunities in themselves too. But do not trust the numbers that are on the packages for brokers unless they're well respected and they actually do the business right, because there are some people who put the actual good numbers on there, but a lot of people were massaging the numbers to make the cap rate one way or the other, right? A cap rate is really not a real number unless you're using actual expenses and actual income. And those can change from person to person too, if they haven't calculated the new property tax that's going to be assessed. Those little details can change your NOI pretty significantly. Um, Different markets too, high tenant turnover. I think if people are constantly moving out, that's a lot of expenses that you got to do to repair those units and lease up costs. And if you hire a leasing agent, that can be very difficult as well. Um, Obviously, know the regulations and the legal requirements. RSO, rent control. You can't go in there and kick all the tenants out and raise the rents. There's legal provisions put in place that you have to understand what's happening from a micro level in that specific market. It could be a town, it could be a neighborhood that has different laws, it could have different zoning requirements, different setback requirements. Real estate is such a boots on the ground micro understanding, and that's how you really win in this business, is you have such a deep understanding of that if you're not familiar with those regulations and what you have to overcome as a landlord, then you can be blindsided by something that, is standard practice in this little market but not anywhere else where you've invested. And then last one is this one's a little bit more of a personal preference, but understanding how you're looking at deals. Do you care if the price per unit is significantly above what other properties have traded for, or the price per square foot? Or are you just looking at the cap rate and the cash flow and the cash on cash and the return? Do you plan to sell this? Do you have investors who are investing in your business? Understanding that model and understanding, can I get to my specific return based upon my assumptions? Those are all things that I see new investors make mistakes on, where even if you're underwriting to sell a property at a 6.5%, right? You're going to buy it at a 5, you're going to renovate it, you're going to get it to a 7.5, and you're going to sell it at a 6.5. Great. Maybe all the comps say that you can sell the property to 6.5, but if your price per unit is $100,000 more than all the other comps that are trading at a 6.5 cap, it's very unlikely that an investor is going to want to buy your property versus another one with a lower price per unit, price per square foot, with the same cash flow and the same cap rate. So those are the nuances when it comes, and to figure this out too, study the comps, call the brokers, get their opinion. Like, I love when people call me they're buying a deal not with me, and they're asking me, hey, what do you think of this deal? Like, does this make sense? Do my assumptions make sense? I think leveraging other people, which is where the network comes in, is very, very helpful. So those are just a few red flags. I've probably talked enough, but yeah, hope that was helpful.
That absolutely was helpful. For sure. I think you pointed out some really helpful tips that, it can be really easy to get emotional and get excited when you see what looks on the surface like a good deal without going through all of the steps. So it's really important not to miss any of that. I'm going to switch it over to our next section, which is about financing deals, which is why we brought Julianne Peterson with us. She's obviously has worked a ton of deals and knows what it takes to finance a deal in today's market. So, Julianne, what have you seen change in the past year? I mean, even in the past month, and what you're seeing investors do to adapt, or how you think they should be adapting to those changes?
Yeah, I think the lenders are getting tired, especially the ones that were taking out bridge loans. They're getting tired. They recognize that the value of these assets have gone down. A lot of these deals do not make sense. Um, they're looking to help the owners and operators of these assets, and they're modifying these deals. So we're seeing that very different in today's market. These operators are also tired. They're tired of having to put their own money into these assets, trying to keep them stabilized, you know, keeping them, when we say stabilized, we're talking about 90% occupied. It's been very, very challenging with all of the COVID kind of transition. People were moving into back home, then they went out and they ended up renting after COVID. They went out on their own and now they're moving because they know that down the street they can get a cheaper price because all of these properties got delivered and these new operators are giving deals. So if you thought your property was stabilized 90%, 95%, you're quickly losing some of these renters for something a little less expensive. So while these operators, they've also had to go back to their investors to see if they could have a capital call. I need some more money. I cannot continue to run this asset. As Taylor mentioned, the insurance has just killed a lot of these deals. So with the expenses up, the rents coming down, it's been very challenging. Interest rates, we didn't think they'd stay as long as they have. We thought that there'd be another five this year. We're hearing two, maybe a little more. So all of those things are challenging in this landscape in today's market. Now we've got the tariffs trying to come in and kind of how do we navigate that, especially with people that are in ground up construction? What's that going to cost? We own, our land. We have this market analysis. We think we can deliver this in 2 years, and the tariffs come. So again, it is a challenging time for a lot of operators.
Hmm. Yeah, you touched on some really, really good points there. Um, Things that I think can provide a little bit of uncertainty. But in this uncertain time, what are some tips that still would hold true, especially if we're looking at, I know we have people of all levels of experience on this webinar, but especially going into, let's say, multifamily for the first time, what is something that they should be looking out for to get financed, to not run into some of these issues that you mentioned?
Yeah, I'm always helping our clients figure out because at the end of the day, your lender is your biggest partner. So you want to build relationships with lenders. You want to obviously with brokers on the agency as the uh, sales agent, but your lender really is very, very important. And we have to kind of figure out what is the roadmap to getting these deals done. You really should be working, especially the new folks, with a team. The team is your lender, is your broker, is your insurance, is your investors. And when you're looking at these deals, whether it's, as Stacy mentioned, the smaller deals, 10 to 40, you might not be able to get that done all by yourself. So, where's the money going to come from? Where's the experience? The lenders that we work with, we do bank, we do bridge, we do agency. Agency is your gold standard. We're going to look for somebody on your team that has net worth equal to the loan amount. We're going to look for liquidity that's cash in the bank. And we're going to look for somebody who has at least 2 years of experience. Now, if you're brand new, you need to go out and network, as Taylor mentioned, to find somebody that's going to help hold your hand. Now, when I got into this, I said, no, no, I can wear the cape. I can do this myself. I don't need teammates. But I have to tell you, in commercial real estate, especially in multifamily, you cannot do this yourself. And our RMFIA, which is Stacy and Jen's group, they do a really good job of figuring out what are your strengths and what do you bring to a team. And knowing who those people are and what they bring to the team is so, so important. So from a lending standpoint, I'm going to look for each of those boxes, your net worth, your liquidity, and your experience to be checked. when we go into a deal, because the worst thing is you've got a deal under contract and we can't get that completed because you don't have the right team members. So that's what I would say, knowing your roadmap, who's on your team, what are they worth, putting everybody together. And and here's the thing, I would really, really encourage people that when you're underwriting these deals, you know what the lender's going to allow, right? Your net worth, liquidity, and experience. But you also want to make sure that when you bring the deal to the lender before you put in the LOI, so many times somebody will come to me and say, hey, I've got an LOI accepted. Can you underwrite this? And 9 times out of 10, they're overpaying because me as the lender can only bring, let's say, 50 to 70%, and they've underwritten this at 75 to 80%. Now you have to either go find more investors and then your returns go down, or you have to go and renegotiate it. And I would say that's going to not, for long-term relationships with these agents, can really put you in a peculiar situation.
Yeah, absolutely. We got a comment here in the chat as well. And I think Taylor gave a good response here as well. Should we come back to this, Taylor, or do you want to address this
I
right
can I
now?
can I can address
Yeah,
it to the group for the good of the order.
sure.
Michael asked if it seems to me that for income properties that one should consider a minimum target cap rate is a percentage or two higher than the 20-year amortized finance rate. My opinion is the way that I look at a deal is if I can get a property to be 150 to 200 basis points, which is 1.5 to 2% above the market cap rate, I feel like I have a pretty good cushion in terms of then if I'm stabilized at a 7.5 and I can sell it at a 6, I will make money. The difficulty in that and what's happened over the last 2 years is people were underwriting those stabilized cap rates at 5 and 5.5, where, today that cap rate is a 5.5, 6. And so they're not 100 or 200 basis points above where the market cap rate is. So I think that's the difficulty when it comes to value add. I mean, I'm sure Stacy has some thoughts on how you're looking at a deal, and it's obviously individual for whatever your investment risk tolerance is. But Stacy, I'd love to know like your thoughts in terms of if you have any rules of thumb for deals.
It's not so specific as that because when we're looking at a deal, we'll do like a full underwriting of it. Um, One of the things we can never predict, even though interest rates should have nothing to do with the value of the property, there's no calculation that interest rates equal value. But the reality is investors buy or don't buy based on cash flow. And cash flow is, even though that cash flow doesn't drive the value, net operating income does. But at the end of the day, if the interest rates are so high that there's nothing left of cash flow, what's the point of buying it? So one of the things that when we're looking at a deal, and especially when I'm, working with someone who's a little bit newer in the business, I'm like, look, the reality is if you have a 5-year exit, 5 or 7 year exit, which is generally what I as soon as interest rates started getting, they have been low for just too long. I just know I've been around for a long time. I'm like, these interest rates have been low for way too long. And so I told my students, like, look, you need to be careful with these 3-year deals, these 3-year holds you're looking at, because you might need more time in the market if things correct. And we have a correction coming. So I've always been a little bit on the longer game when I'm teaching about multifamily. So I get 5 years, 7 years out. We have no idea, zero idea where things are going to be at that time. All we can do is make uh, reasonable assumptions. And so one of the things I always tell them to do, like whatever you think the cap rate, the exit cap rate is going to be for every year planning on holding it, you need to go up, up, up with your cap rates. And I know that makes your numbers look worse when you're trying to present it to investors, but all day long, would you rather be able to say, oh, this is, it's a decent deal, and then end up coming out and it ended up being a great deal and you have all the happy investors and happy self, or you present it as this amazing, great deal, and then what you are able to deliver is meh. You're never going to have those investors invest with you again. So anyway, at the end of the day, Taylor, what I always teach is not so much about, oh, go X% higher. I'm just like, look, you don't know. that's the reality. I went through 2008. I got my butt handed to me. So I learned the hard way. You truly don't know what the future holds. So if you can be more conservative in the beginning, you're either going to be okay, or you have a better chance of under promising and over delivering instead of the other way around, which is what so many operators are like that Julie's talking about in the Sun Belt are dealing with is
Mhm.
they over delivered and are way under or over promised and way under delivering. And that's just, it's a horrible feeling. Uh, I never want any of our investors to have to deal with it, nor less have their investors feel that way about them.
Let me add
So
something too, real quick, Alexandra. Have an A plan, a B plan, and a C plan. Like the best investors that I know, hey, here's the A plan. If this goes great, perfect. If that doesn't happen, what's our B plan? And we're still going to be okay. And C is like break even, worst case scenario. What happens there? If you can clearly understand what those look like, I think you can have a lot more confidence going to your investors and raising the capital and feeling good about the deal and taking people's money to help you buy those. So I'd like just to add that.
Yeah, absolutely. Great addition there. And Julianne, any comments there that you want to add on as well? Maybe also, some common mistakes, other mistakes that investors might make in trying to raise capital as well.
Well, I would say one of the biggest challenges that we're seeing right now is that equity is really, really difficult to find. So Warren Buffett
Mhm.
that says, when things are bad, that's when you should be buying. And that I love that. I love that comment. However, right now, a lot of these investors that got into multifamily 4 or 5 years ago, they do not have any money left. They put in for capital calls, they put in as much as they could because they thought it was bright times. However, now they're saying, hey, I can get a 4%, 5% return from banks, and I'm not getting that. I don't see that. I don't trust these operators. So finding equity right now has been a huge challenge. So I would say my suggestion is find smaller deals. That has been the biggest aha for a lot of these operators that were jumping in 100, 200 units, and they were moving that through them every 18 months. They were making a bunch of money. Now they quit their jobs because they were, looking at acquisition fees, two, three, four of them every year. They've had to either go back to their full-time job or they've had to go into smaller deals. So I think the mistakes here are they no longer can go with the larger deals, go with some smaller deals, find right partners. Again, a lot of these deals that are being taken back by the lenders are partnership disputes. There's a lot of breakups. This has been a very stressful time. And so making sure those, your partners that you're starting to work with, that they have the same values, the visions that you have. Are they able to get a hold of you at the right time when you can talk, and can you guys jump on a call? So making sure those partnerships are in place, and always making sure that wherever you're buying, I know LA is a little bit different, but that is a landlord friendly. This is changing in a lot of these markets. There has been some concern about rent control in certain markets, and trying to find those different markets. While I'm going to close a deal today in New York, people say, oh, I don't want to go to New York because of the rent control. But in certain smaller markets in New York, they don't have it. So finding those, making sure that you're not, your understanding, as Taylor said, knowing what those restrictions are, can keep from, having you make mistakes.
Yeah, absolutely. Robin had a good comment here in the chat asking, what do you see with larger operators to keep and improve values 50 to 200 units or more? So that's interesting. You mentioned going smaller, Julianne. What if you went bigger? What do you do to improve those values? I'm sure all of you might have a comment on that. I like that question.
Yeah, improving values is really coming down to the operations of the asset at this point.
Mm.
Everybody's kind of trying to keep all of the residents in place. So having some some occasional parties, keeping the retention has been very, very helpful. So I don't necessarily believe that there's improving the values, but keeping the lights on and the people happy that are there. Now, certainly you can do some CapEx, improving the flooring, the painting, the pavement, just some of those things, right off the bat. But if you own it, you just want to keep people in those in the doors.
Absolutely. It's always easier to keep a good tenant, right, than go out and find a new one. That's always risky. Stacy, would you agree with that? Any other suggestions there?
So in the 50 to 200 unit range, so we have a 96 unit, and one of the things that we've done, and it was full when we got it, um, but we could tell it was full with not necessarily people that you want to be full
Mhm.
with. But one of the things, once we got that whole year one plan done and got the tenant base a little bit fixed up, what we have focused on, which has truly added value to the property and the tenants, is focusing on like what are those little things that we can do to make their experience better. So, for example, Alta Fiber had contacted us saying, "Hey, we would be willing to, take all the capital expenditures of laying fiber in the entire building for every single unit, providing the modem, and we will offer that to you for $35 a month." The residents, if they go by themselves to go get it, that would be a $75 a month expense to them. We'll charge you 35. You can charge them whatever you want. And so we were like, okay, we'll do 50. So that leaves a pretty big gap. So the residents are like, oh my gosh, I can get this amazing fast internet for $25 a month less than out. And it's because the landlord did that. So one, it's a service to them. It's a perceived service and a real service. And also that $15 per month per unit, not only did that add cash flow, which our investors loved, we loved, but also massively increased the value of the property. So we look for opportunities like that, it is just straight up a win-win. Like we
Yeah.
did another one we did on that one was valet trash. So instead of them walking, because it was quite a ways for them to walk to the trash cans, 5 days a week to have someone come and pick up trash from right in front of their door. And we charge them $22 a month for that, and we pay 11. So again, they are thrilled to have a tiny expense that saves them a lot of time and hassle. And we make more cash flow and we increase the value. And they're thrilled and happy. And it's making our tenant retention, they're just staying longer because it's a great place to live. But on top of it, the landlord, the owner, whoever that is to them, is continuing to look for opportunities to make their life better. So I'd say that in addition, obviously you always want to have your units filled. That is the absolute number one priority. But beyond that, we're just looking for how do we make their life better and have a little bit of a spread. And it's just a huge win-win.
Yes,
Yeah.
it's not a coincidence that I had DirecTV sponsor this webinar because they're offering something similar like what you said with the internet in that, hey, let's give them something that we know most people do, right? Most people watch TV, most people need internet, and just make it better and more affordable for them, but you're also making money as well while you're doing that. It's like the best case scenario. Taylor, you were going to say something.
Yeah, ancillary income, exactly what you said.
Yeah.
The way that I've seen it be done, obviously, if you can do the rubs, the utilities are a big line item.
Yes.
If you can, as new tenants come in, implement a program like rubs, storage, charging for storage. If
Mm.
you have unused space, maximizing the space that you have in your property. Parking, sometimes you can charge for parking depending on what part of the country you're in, if parking's hard to find. And then the big one that I've seen is unused land and space. And specifically in California, there's a new law called SB 1211 where you can build up to 8 detached ADUs on a parcel if there's 8 units or above. And so what I've seen a lot of investors do is use that unused space that previously you were limited to 25% of the dwelling units. Now you can build 8 ADUs on that excess land. And the math really makes a ton of sense from a cost perspective in most markets. Um, in some markets, it may not be in terms of value for the asset because the cost of building it is going to be about the value increase. But from a cash flow perspective, you can significantly increase the cash flow with the rent in those markets. For example, it costs you $200,000 to build it. You can rent it out for 2,000 bucks. Like that math on a cap rate basis makes a ton of sense, at least in Los Angeles. So I think trying to build, or if you have the capabilities of using excess land, that's another way that I've seen these big investors try to maximize, the real estate that they own.
Those are great suggestions. Okay, I'm going to take it back to deal structure and closing the deal. That's the kind of phase three here. Turning it over to you, Julie Ann. What does a successful deal structure look like? You mentioned going smaller. What does that look like versus a more experienced or sort of larger deal structure?
We always try and put people into the best type of lending, which is non-recourse lending.
Mhm.
So right now we're underwriting deals that are 65 to 75% leverage. If you're in larger markets, top markets, you can even get to 80% leverage. That's a great that's a great amount of money, that proceeds that we can get for you. It would be closer to a 10-year yield, which is, today it's at 438 plus about 200. So you're probably financing this around 630, 650. We're seeing the rates, depending on which way you go, you can lock in the rate. And in today's market, that might be helpful because it's moving just incredibly. So there's lots of options for people. But I would tell you that, 10 years ago, we did a lot of 10-year loans. Now we're seeing a lot more flexibility. People taking on 5 to 7 year loans. And if we can also see a step down approach, meaning we know exactly how much it's going to cost to exit these loans, so that you can put those into your underwriting. So those, I think, were a lot of things that you need to be thinking about that are advantageous to the transaction.
Mhm.
If you go with a bank loan, you're going to be working on a 20 to 25-year amortization, where when you go with agency, you're going to get 30-year amortization, which means your payments are a little bit smaller, therefore more cash flow, therefore more distributions for your investors. So we always try and put our operators into those loans. They start at 1 million. So these deals that are at 10 to 20 units or 10 to 40 units can certainly participate in those.
That's great. Taylor, did you have some slides as well to kind of, piggyback off of what Julianne just kind of talked about? I think you had a couple slides there, or was that the end of
These
the
are
PowerPoint slides?
these are more for deal
Mhm.
structures in terms of like GP LP equity standpoint.
Okay.
So I didn't know if I think you guys were mentioning more of the financing aspect of it, but
No, I'd love to see that as well. I think that's also important for us to review. Yeah.
okay. All right, I'll go through it quick because I
Great.
know we're running out of time. But let me see if this was okay.
I would
Got that.
jump in there in just a minute.
Mhm.
From a lender standpoint, we don't
Mhm.
look at the structure. We just want to know that we're getting paid. And so we'll put in there a debt service coverage ratio from 1.2 to 1.4, sometimes as high as 1.55. So we don't necessarily look at that. And this is a great
Mhm.
transition into why Taylor would have you look at, from an investor standpoint,
Mhm.
returns.
Yes. And thank you for that, Julia. It's very true. So I'm not going to go through every one of these points. This is available on that link, thegroupseries.com/AAOA, if you guys want to go look at this later. But basically, the way that a lot of clients work with, and if you're doing your own deals, right? You're the LP, you're the GP, you're the everything above. And that's mostly going to be personal cash. You're going to put 25 to 35 to 45%, depending on the cap rate down. You're going to go traditional bank. Sometimes you can do bridge debt financing, which is a higher uh, hard money loans as well, which are typically IO, and those can be strategic as well if you have a business plan there. You're having full control of the asset, and you're the one making the decisions. That's where you are the GP, the LP, the everyone in between. The other structure is something where you just want to be more of a passive investor in a syndicated deal, which is where there's a GP, a general partner, and an LP, a limited partner. And you can be either one and still be considered a real estate investor, right? And so as the GP, you're the one running the deal, you're the one raising the capital, which is probably most people on this call. They want to go do deals, be the owner, add the value, things like that. And this is not as in depth as you can go in terms of the structures and waterfalls and all that stuff. And if you have questions, I'm sure any of us can answer the actual detailed structure of it. But what you have to understand is you're taking money from other people and you're promising a certain amount of return. And depending on what that person wants, what they're okay with, everything is negotiable up to that point. And so I think having and understanding some of these rules of who's in control, who's making the decisions, what are the returns going to, where does the money have to come in and where does it flow out? Those are all things that if you're starting to do syndication, which a lot of people when they're first starting out are family and friends money, it's good to have a basic understanding of how to do that. And also, which not a lot of people know, like how do you set up an operating agreement? How do you go get an attorney to write something like this up? So I think having those dialed in when you're beginning your journey or continuing your journey or want to expand to maybe I want to do a fund. There's a lot of steps along the way and reaching out to people like Julianne and Stacy who have been doing this for a very long time, or people like myself or other owners and operators, they've made the mistakes, so hopefully you don't have to. And so learning from their mistakes can save you a lot of headache and heartache and hopefully money along the way.
Well
I would just
said.
jump in. I
Yeah.
would just jump in here just so that everybody understands this real clear analogy that a limited partner is like being in the back of a plane. You are a passenger in a plane, and the general partners are the pilots. Now, in the back of the plane, you do not get to tell the pilot, hey, this is what we want, this is what we need. You wait for the operators to tell you this is what we're doing, right? You can have a little bit of input, but for the most part, the general partners are going to take your money and they're going to be good in fiduciary responsibility of your money. But at the end of the day, as a limited partner, you have some limited abilities in that transaction.
One note I would add to that though is that if you get to the big boys, the big institutional firms, the institutional LPs are calling the shots. And so I don't suspect anyone over here is doing deals with BlackRock and these big pension funds, but for our example in these small deals, that is 100% correct. The GP is the one driving the ship, and the LPs are the ones who are ideally getting the returns from it.
Mm. Stacy, so obviously you coach your students. I'm sure you help them put together these types of deals. What is your take on anything that we missed or might have not covered so far on this structuring of the deal?
I see the main thing I'd say is when people are getting started, I am not a fan of people doing syndication to start. The
Mm.
complexity of it is insane for a brand new investor. Like there's enough of a learning curve, right? So I've been very public about this, and I know that there's a lot of people that don't like me because of it, and clearly I care. But the way that people can do this a lot more safely, which is good, what's going to have them still be investing in 20, 30, 40 years is starting off a little bit smaller where you can do what Taylor's considering a smaller deal under $1 million that you can do as a joint venture. Obviously, when I say joint venture, if someone has enough capital, they could do it on their own. It's just a lot to do. But starting off with something that's a little bit smaller, one, is so much easier to fund from a joint venture perspective and allows that investor to get in and understand the business. There's a lot to it. There's so much money to be made. And if there's so much money to be made, that means there's also so much money to be lost when you make mistakes. So if you can, kind of cut your teeth on some smaller deals, I tell my students, like even a 10 unit, you are going to be shocked at how much you learn. It is going to shock you. It's like a 4-year degree in one deal, but you take the learnings from those smaller deals and you apply it to the next size up and the next size up and the next size up. It doesn't have to take you 5 years to do your first 100-unit deal. I mean, I've had my students in 18 months doing a syndication in a 100-unit deal, but they did 5 or 6 smaller deals along the way. It gave them experience, it gave them credibility, and it gave them confidence to know that some of the difficult things that came up in those smaller deals or the mistakes that they made in those smaller deals, they take that wisdom and carry it on to the next and the next and the next. And it's not instant gratification. I want a 100-unit deal. But the reality is, when you take on a big deal as your first deal, you're probably going to lose everybody's money along the way, and then you're going to be out of the business. And I stand for long term. And so that's my only thing that I say is when you're starting, do with the deal, solo or with a joint venture, do a couple of them, two or three of them. And then you are more prepared to step into the world of syndication, which that jump is mind-blowing, the complication factor. But it's not that big of a jump if you've already done a few deals. So that's my only thing that I preach. Do not start with syndication. You will hate yourself and want to stab yourself in the face over and over with a fork for doing it. So I'm only a little bit passionate about that. Only so much you notice.
Speaking from experience.
Totally.
Well, it's been wonderful having you all here on this talk today. I just want to close this out with what's the best way we can find you, follow you. I'm going to put this information in the follow-up email with the recording, and Taylor shared the link to his slides. So you can click on that. I'll put that link in the follow-up email as well in case you don't get it now. So you can connect with our experts after we close up the webinar. But let's hear it from you. Where can we find you? Stacy, you can start.
I think if you go to warriorsofwealth.com, just like it sounds, we have eight free master classes that I've done over the years that are related to multifamily. It's just a really good place to lay a foundation. And that's why I say probably the best way to connect with us.
Okay, warriorsofwealth.com. Taylor?
Yeah, thank you. Thegroupcre.com is my website. I just put my email and phone number if you want to call me. I'm
Nice.
pretty much again on the phone all the time. And then social media, Taylor Avakian. I post a lot of stuff that I deal with on a day-to-day basis and some learnings and things like that. So yeah, if you search my name, you'll find me.
Great. And the name of your podcast? 'Cause
Oh
you
yeah,
have-
no vacancy with Taylor Avakian. If you guys have some road trips, it's
Okay.
really fun and there's some really good guests on there.
Love that. Julianne?
Well, always, you're all welcome to come to Zoom at 8 every Tuesday night. We have industry experts come and join us and speak about a service, some of their experience in the industry that we network and learn after they're finished. So that's every Tuesday. You can look us up at zoomat8.com, Zoom, ZOOMAT 8. Old Capital. Lending.com is also where you can find us. I'm on all the social medias, Anne Peterson.
Okay. All right. I'm going to put all of that in the follow-up email. Okay, guys. So if you didn't write it down, don't panic. We will find ways to connect you with our speakers again. And thank you all for joining us and for all of your time, because this is super valuable. This is how we learn. This is how we hopefully don't make mistakes, or maybe fewer of them. So thank you for joining, and we will be in touch tomorrow with everything. So have a wonderful day, everyone. Bye.
Thank you,
Thanks so
everyone.
much.
Thanks, Alexandra.